Have you ever wondered why the world's biggest banks, J.P. Morgan, Goldman Sachs, Bank of America, quietly prepare for a market crash, even while publicly saying the economy is strong? Why do their internal risk models, liquidity positions, and investment shifts suggest a totally different story than what they tell the media? Because somewhere behind the curtain, financial storm is forming, one that the average citizen will never see coming. Today, we're going to uncover the hidden signs, the secret indicators, and the real reasons big banks expect a major crash, quietly, silently, but urgently. And once you understand these signals, you'll never look at headlines the same way again. Stage-setting background plus hidden twists. Before we dive into the present, we need to understand the long shadow of history, the patterns that repeat like clockwork. Every major crash in the last 100 years began the same way. 1929. Banks aggressively lent money, then quietly pulled liquidity right before the crash. 2000. Banks pushed tech stocks while insiders were already selling. 2008. Banks encouraged home loans while betting against the housing market. And today, banks are doing it again, but smarter, quieter, and with more data than ever before. Behind their confident interviews lies a different reality. Massive increases in loss reserves, surges in short-term hedging, pullbacks in lending, internal reports warning of elevated recession risk. The public never gets these warnings, but you will today. The story unfolds chronological cause and effect. 1. Origins: how the system got fragile. To understand why big banks expect a crash, we need to examine the pressure building beneath the economy. A. Record debt. Everywhere, U.S. government debt over $34 trillion, consumer credit card debt at all-time highs, corporate debt pushed to limits by low rates. If this alone isn't the disaster. The disaster is that interest rates suddenly spiked, turning cheap debt into a ticking time bomb. B. The bank business model broke. Banks earn money by 1. Taking deposits, 2. Lending at higher rates, but when rates rose fast, two things happened. Their old low-rate bonds lost value. Borrowers suddenly struggled to repay loans, meaning banks quietly began facing losses even before the public saw anything wrong. This leads us to the rise. 2. The rise: hidden decisions made inside banks in early 2023 to 2025. Something interesting started happening behind the scenes. Banks began hoarding cash. Major banks increased their liquidity buffers. Billions suddenly moved into treasury bills, overnight reverse repo, Fed facilities. Why? Because in times of fear, banks don't hold risky assets. They hold cash. Be quiet: loan tightening. Publicly, banks talk about economic resilience. Privately, they tightened credit, reduced mortgage approvals, increased corporate lending requirements, rejected risks they normally accept. That's what banks do right before a downturn. See massive hedging activity. Some of the largest banks in the world began buying S&P put options, volatility hedges, treasury futures. You only buy insurance when you expect a storm. This rise of internal caution leads to the breaking point. 3. The breaking point: the moment banks realized the crash was coming. There wasn't one moment, or 3. Consumers started to crack for the first time in 12 years. Credit card delinquencies surged. Auto loan defaults jumped by now. Pay later debt exploded. Banks saw these numbers months before the media. They knew households were no longer holding the economy together. B. Commercial real estate imploded. Offices in major cities saw vacancy rates hit record highs. Billions in office buildings suddenly became nearly worthless. Banks who financed these properties secretly marked down loan values, quietly raised reserves, silently prepared for losses. C. Treasury interest costs blew up. As the U.S. government's interest payments crossed $1 trillion per year, banks realized something dangerous. The U.S. had entered a zone where debt growth outpaced economic growth. When that happens in a country's history, the end game is always the same: inflation, recession, or a financial reset. Banks saw the writing on the wall long before ordinary citizens. Spills into the fallout. 4. The fallout: how the system started cracking from within by mid-2025. Pressure grew from all sides. A. Liquidity vanished. Some regional banks quietly failed. Others relied heavily on Fed emergency programs. Liquidity draining is always the pre-crash warning. Be corporate. Bankruptcies rose. Companies with floating rate debt couldn't survive. Restaurants, retailers, real estate developers, a wave of defaults began. Banks responded by quietly cutting risk exposure, increasing internal stress tests, preparing for a recession. Narrative C, the false calm. Before the storm, markets reached new highs. Tech stocks soared. Crypto boomed, but banks didn't believe this rally. They treated it the same way they treated the 2007 market highs, as a trap. 5. Failed fixes. Why the solutions aren't working? Governments and central banks tried to stop the bleeding. Rate cuts backfired. Cutting rates didn't stimulate the economy. It signaled fear, not confidence. B. Printing money isn't possible. Like 2020, inflation still lingers. Fed can't simply inject trillions again. C. Stimulus won't cover global debt. Every major country is drowning. Japan, China, Europe, US. This isn't a US-only crash. It's a global leverage explosion. Banks see this. They know no quick fix can unwind decades of artificial growth. Modern parallels, shocking data now. Let's connect this to today with real patterns. Pattern 1. When banks hoard cash, recession hits within 12 to 18 months. This happened in 2000 and 2008 and 2020, and again today. Pattern 2. Surging defaults always precede market crashes. Right now, auto defaults. Highest since 2009. Credit card defaults. Highest since 2012. Mortgage delinquencies rising again. Pattern 3. Every time interest costs exceed defense spending, crisis. This happened only twice. The 1970s. Today in 2025. Pattern 4. Commercial real estate collapses always break regional banks. We saw this in the 1980s S&L crisis. We're seeing it again now. Big banks aren't guessing. They're following patterns that repeat every single cycle. Conclusion 3 takeaways. Warning, call to action. And takeaway 1. Big banks expect the crash because the data is unmistakable. They see consumer strain, corporate defaults, and government debt stress months before it's public. Their hedging and liquidity positions prove their real expectations. Takeaway 2. The market looks strong only on the surface. Behind the scenes, banks are preparing not for growth but for impact. They're protecting themselves, not the public. Takeaway 3. This isn't a normal recession cycle. This is the collision of high interest rates, record debt, weak consumers, fragile banks, and governments running out of options. This combination has only happened a handful of times in history, and it always ends dramatically. Final warning: if the biggest financial institutions in the world are quietly preparing for impact, you should at least understand why. The next 12 to 24 months may not look like anything we've seen before. Call to action: if you want clear explanations, deep breakdowns, and early warnings before the mainstream media reacts, subscribe to the channel, leave a like, and turn on notifications so you never miss the next episode.